It's interesting to note that you shouldn't have an all-time high in the stock market and a near all-time high in gold simultaneously. They're counter-cyclical assets, so if the economy is great and stocks are booming, there's no need to own gold. But the thing that's eerie to me is that, like, the last time other than right now that we actually had an all-time high in stocks and a near all-time high in gold was right before 2008. And what that is, it's a symptom of the smart money, the hedge funds, the billionaires, the insiders, the people you're talking about. They're proactively rotating capital into what's going to do best for the next several years ahead of everybody else. And so what happened in '08 was all-time high in stocks, all-time high in gold. Well, the stock market crashed by 50% in the next year. Gold pulled back initially by only 20%, and then it tripled in the next 3 years because all that rotation of capital, once people were actually losing their shirts, they at some point had the realization, well, I need to go into what's called risk off. I need to now own the safest assets. When you have that kind of significant capital rotation, then the prices go bananas. We saw a taste of that this year earlier in December, January, February with everything that was going on, but we haven't seen anything yet.
Hey, Inspired Tribe, my fellow freedom lovers, John Nolan here. Thank you so much for tuning in to another inspired conversation. And listen, if you're anything like me, you might not really see yourself as an investor, but truly we all are. We invest every day into things that we need, but then also we need to look at the future. We need to look at how do we care for our families and how do we preserve the wealth that we've already built. And I want to say that it's never been this difficult. And in other ways, it's never been this easy to make a decision because certain signals are very confusing while others are crystal clear. And that's what I want to talk about today with precious metals and economy expert Micah Haince. It's great to have you back, brother.
Thanks, John, for having me on. It's been a little while. I hope you're doing well, and thank you so much. Yeah, lots to cover since we were on last.
Yes, doing pretty good. Recovering from a little bit of, like I told you, pesticide poisoning from some stubborn neighbor farmers, but we're getting there. Micah, the first thing I want to say is thank you. You've received some wonderful praise from our audience that have been in touch with you and that said they couldn't have been cared for in a better way with their investment needs. So thank you for that.
Yeah, no, it's my pleasure. Everyone gets the royal treatment here, and I'm just happy to be working with audience members of yours. So it's a pleasure too. And those that have become clients, um, I couldn't thank them enough too for placing their trust in business with us. But it's the relationships that I'm really after too. I've got a lot of great clients now from this audience, so thank you so much, and I look forward to many, many more.
Thank you, Micah. And I want to dive right into it. Off in the green room, so to speak, off camera, off the record, I told you, man, if you're not like in the inner circle of governments right now, in the power echelons, it's impossible to predict what the stock market's going to do. It's so it doesn't make any sense any longer.
Yeah.
And I know there's a lot of people out there who've worked on their lives who have either retirement savings or investment accounts or are just wondering where they should put their cash. And I want to talk a little bit about where you are currently, where you stand on that, what you see sort of in the big picture things, what's going on in the world, and how crazy is the market right now from your viewpoint.
Yeah, it's been an incredibly volatile period across the board. We're seeing stuff now that just does not bode well for most things: the economy, interest rates, the dollar, the stock market, the cost of everyday goods with what's happened to oil, the ripple effects and the shock waves that are, that we're feeling now and that we'll feel a lot more of. Unfortunately, this conflict in the Middle East has repercussions that have yet to be felt. We can get into that, but I think it's been a really hard time for investors to know what to do. Gold and silver through the fall had a great run, obviously. We've been consolidating at much higher levels than where we were, even just a few months ago, but we are going sideways in the consolidative zone. Gold and silver obviously are an asset to own that can produce great returns, but the primary function of them is to be safe, right? They go back a millennia. You can never have your gold and silver go to zero. You don't own dollars. You're not in the bank. There's no counterparty risk. These are the reasons to own physical gold and silver. And I think there's a role for physical bullion in everyone's portfolio right now. If you look at stocks, they've been doing really funny things. did nothing from October to March. They dropped significantly into the beginning of this conflict. And then out of nowhere, over the last 2 weeks, they've ripped higher. It's the fastest, steepest recovery we've seen. And on no news, on nothing positive economically. The conflict has not been resolved. Oil prices remain high. That's passing on higher cost of goods and services to everybody. Fertilizers, there's going to be issues with that and other chemicals. The latest thing that I'm onto the last couple of days, I'm hearing about motor lubricant shortages that are going to roll through the system. And oil changes are already 30 to 50% more expensive, and I don't even think we've seen anything yet. And that's the next thing to probably be hoarded. And so, you look across the board. The stock market just isn't behaving in the way that you'd expect. But I think that the central bank has been accommodative, trying to provide liquidity to keep it going. As you know, we're in a midterm year, and as cynical as this may sound, they're going to do anything and everything they can to keep it going, because one of the biggest barometers for an administration's success is how the stock market's doing. So we're near all-time highs, but to me, it doesn't seem sustainable, because to have a sustainable stock market rising at the angle that it has been, you'd expect to have a strong economy. But look at layoffs. Look at AI substituting everything out. Look at consumer spending. Look at consumer confidence. Consumer sentiment, it's the lowest that it's been in over a decade. So people don't feel good. Their typical 60-40 portfolio actually isn't going to be something that I think is set up for what's coming. 60% stocks, 40% bonds, or 70-30, depending on your risk appetite. Bonds are down like crazy, and that's because yields are shooting up, and people are actually selling government bonds because they don't think that the inflation environment is going to be any better in 5 years, 10 years, 20 years, 30 years. And I don't think so either. Higher oil means higher inflation. And so, as we've talked about this before, as the bond price goes down, yields go up. So people are selling bonds because they're not confident they're getting paid well enough to hold on to them long term. And I agree, but then the ramifications of that is that higher yields means higher commercial debt for everything, higher auto loans, higher mortgages. I think I just saw that the 30-year mortgage rate's like 6.78%. So the ripple effects, again, for auto loans and lines of credit and business lines of credit, any credit card debt, it's all just going to get more expensive. And of course, if you look at the economy as a piece of the pie, if that much more is going to debt servicing and that type of stuff, and cost of goods are going up, that means there's less discretionary money available for other parts of the economy that people want to be spending, but they can't because they're getting pinched from all sides. So all this tells me the economy is pretty weak. The stock market's not reflecting that yet, but I wouldn't be shocked to see something like a 2008 moment over the next year, let's say. Very hard to predict. And I think anyone who's tried to call a stock market crash for the last little while has been unsuccessful. It's not something you necessarily want to time. But that's why, as an investor, I saw the writing on the wall over 10 years ago that a devalued dollar, higher inflationary environment, weaker economy, and that combination is referred to as stagflationary, right? You have high inflation and a stagnating economy. That's kind of the worst thing to live through. We haven't seen that. It's a pretty rare. It's a pretty rare combination. We haven't had that since the 70s. But from 1974 to 1980, gold rose by 24 times, and silver rose by 37 times, alongside oil, which also 10 times. So if we're going into a stagflationary environment with all the things that are kind of moving around, I think it bodes very well for gold and silver. The fact that they continue to move sideways at much higher levels should be viewed as an opportunity to get in before they launch out of this base, this price level that they're consolidating in. And I touched on the 60-40 portfolio. 2022 was the first year in decades where bonds and stocks both went down together about 20 to 30%. Bonds are down right now because of everything we've discussed, but stocks remain kind of elevated. I think 2027, or maybe the latter half of 2026, could look a lot like 2022, where you're supposed to own bonds because when stocks go down, they go up, and when bonds go down, stocks go up. Well, they're not really hedging each other anymore. I think they're both going to be going down together, and that's where I think you got to have some of your wealth in a format that's outside of all these various risks.
Well, if we look at the stock market, we also have to realize that, and an ever smaller group of massive funds and massive multinational corporations are owning most of the stock market. So They can play with that volatility back and forth as they need it, but the small, the sort of the man from the street has no chance keeping up with that. We're talking about algorithmic trading in the millisecond, dimension. So to
Exactly.
me, you know, I can't fathom how someone would say, "Well, I'd rather keep my hard-earned money in a stock market that, can get me 15% in the next quarter or even 20, but then can go and eradicate everything just as fast." Gold and silver have been around for longer than any market, any nation, any currency that we currently have,
That's right.
and have maintained their value and will so. But it's not only a symbolic value. Gold and silver are strategic metals in various markets, but institutional investors have been buying at much higher rates for the last years. Can we talk a little bit about what the big guys are doing in terms of gold and silver?
Yeah, and that's a great point. And I like to refer to the old, adage that you watch what they do, not what they say. And if you look at hedge funds, billionaires, countries, central banks, we're in the fifth consecutive year of record central bank buying. They're buying gold and they're dropping the dollar. And traditionally, they've held large amounts of U.S. Treasuries as a way of accessing U.S. dollars for the purchase of energy. Obviously, part of what we've seen in the peace negotiations is Iran at one point wanted to be able to have all their oil stuff settle outside of the dollar. They don't want to have that. But we have had in the first it was in August, sorry, the first time that it happened in 80 years, in August of last year, the nominal amount of money held in treasuries versus the nominal amount held in gold in foreign value outside of the US is now higher in gold than it is in dollars. And that trend, again, is broken for the first time in 80 years. So I think it suggests low confidence in the dollar, and gold is the best form of a neutral reserve asset. There's no one on the other side of it. You're not in any currency. You're not in any bank. And so I think obviously we should be doing what the big guys are doing. It's just harder to do because you're not told to do it, right? So again, your financial advisor probably suggests, hey, if stocks go down, they can come back. He's never going to tell you about something that I refer to as a high watermark, which I believe we could experience this time around. Something that Japan is very familiar with, right? In the 1980s, Japan had the most expensive real estate and the most expensive stock market. Sounds familiar. That's exactly where we are right now. But in 1989, when the Nikkei, which is their kind of version of the S&P 500, when it crashed by 90% in the preceding year, it didn't get back to the 1989 highs until 2019. It took 30 years to break even if you were an investor at the top. So I'm not saying that we're going to have a 90% correction. I think we could see a 30 to 50% correction at some time over the next year, but I'm saying that that could end up being a high watermark for many, many years. And so if you're 60 or approaching 60 or in your 70s, do you really want to wait? It could be 5, it could be 10, it could be 20 years to get back to break even. And that's where I think like investing in the rear view and investing with what's worked for the last couple decades won't be the same for what we're coming into now, right? We've had a couple decades dominated by financialized assets, so stocks and those types of things and tech, and that's been doing really well. But things come and go, kind of like with fashion, like things are in style and out of style. Well, we've had big 20-year, multi-decade commodity cycles, like what I mentioned in the 70s, through the 60s and 70s. And I think what we're coming into now is going to be much the same. The most important stuff is going to be the stuff that you can put your hands on. So copper's been breaking out. Silver obviously had a historical breakout last year. Gold's at all time or near all time highs. And it's interesting to note, John, that like you shouldn't have an all time high in the stock market and a near all time high in gold simultaneously. They're counter-cyclical assets. So if the economy is great and stocks are booming, there's no need to own gold. But the thing that's eerie to me, and it's an eerie anecdote, is that like the last time, other than right now, that we actually had an all-time high in stocks and a near all-time high in gold was right before 2008. And what that is it's a symptom of the smart money, the hedge funds, the billionaires, the insiders, the people you're talking about. They're proactively rotating capital into what's going to do best for the next several years ahead of everybody else, as kind of FOMO investors kind of rush into the stock market right at the final chapters or final innings of it. These guys are actually getting out, they're buying the next strategic asset. And so what happened in '08 was all-time high in stocks, all-time high in gold. Well, the stock market crashed by 50% in the next year. Gold pulled back initially by only 20%, and then it tripled in the next 3 years because all that rotation of capital, once people were actually losing their shirts, losing their 401ks and their retirement accounts, they at some point had the realization, well, I need to go into what's called risk off. I need to now own the safest assets because I just don't want to lose. Well, the fact is, when you have everyone rotating into a very small asset class, and gold's a relatively small asset class, or sorry, it's very underowned. Silver's an even smaller asset class. So when you have that kind of significant capital rotation, then the prices go bananas. So, I again don't think that gold and silver should be viewed as a place where I'm going to make a ton of money. It's just where I'm going to be able to protect it. Absolutely. But when everyone gets that same thing at the same time, which unfortunately for most investors won't be until after something's happened, then that's when the floodgates open and you just probably can't even get any of it. There were bullion shortages America wide in 2010, 2011, because it was a frenzy, right? We saw a taste of that this year earlier in December, January, February with everything that was going on, but we haven't seen anything yet. We haven't seen the highs in gold and silver. They're in a structural bull market. Silver's breaking out of a 50-year base below 50. That doesn't fizzle in a couple of months. It's going to go on for many, many years. And you know as well as I do, John, that there's just huge structural imbalances for supply and demand for these critical minerals in general, but in particular the things that make the world work and the world that we're heading into. Right? It's all about chips. It's all about energy consumption. It's all about energy capacity generation. I'm hearing from people that their energy bills are up 17% from this time last year because of the data centers that have been built next to their houses. Um, People talking about uh, actually probably having rolling blackouts across the U.S. in a couple of years unless we can figure out how to get our electricity production capacity way up. But these things take time, right? Nuclear power takes 5 or 10 years. Um, Even oil refinement capacity to be able to refine the oil that we have here, not rely on imports, takes 5 or 10 years. So there's a lot of stuff going on that I don't feel that great about. But as you know, I'm a kind of dyed in the wool conspiracy theorist, prepper, and stacker, and there's not a whole lot else that I can do right now to kind of improve my situation. If things happen the way that I expect them to, I'll be okay because I've got food, water, guns, ammo, and gold and silver. I don't think a lot of people are thinking that way, and it's maybe kind of scary to think that way, but I think you got to. I think you got to with everything that's going on.
I couldn't agree more. And we have what we also have, which is different than maybe in '08, '09, is we are we're at the beginning of this, or in the beginning stages of this exponential curve with AI, robotics,
Hmm.
where we there are ideas and estimations, but nobody really knows the full impact, the job loss, the displacement, how long it's going to take for these things to adjust, and
Oh yeah.
universal income. I mean, there's so many question marks as to how the fundamentals, of society are going to function in the next 5 to 10 years. To me, to sorry, go ahead.
Oh no, I was saying, and it's a little scary because like you've got children, I've got children. It's like, what's the economy even going to look like? What's the template for success? We
It's a
don't
com
know. We
it's a
don't
com
know.
exactly. I mean, we're literally, I think, by the end of the decade, we're sort of gonna see the moving pieces clear on the playing field. They're gonna be out in the open.
Yes,
We've seen the AI wave and how that has disrupted things, and that's just the initial boom, right? So
right.
now it's getting institutionalized. Now it's like an octopus going into everything. So to me, as somebody who might not even want to keep up with all of that, who's not interested in being on a daily pulse, how would you how would if in terms of precious metals,
Yeah.
and I can say this, honestly, aside from the land, our gardens, our animals, and the things that you mentioned earlier, like ammo and stuff like that, I am most peaceful and excited about our precious metals investments, just because I know no matter what happens, like there's always something with value here. How would you allocate? How would you do it if you were somebody starting to buy now, or if you wanted to make sure that your retirement is sort of secured? How would you do it right now?
Yeah, I think it's a little bit of a tough question to have a generalized answer for because with every client that calls, we have to figure out what makes sense for them. I have a couple rules of thumb. You can never go all in on anything, and I think diversification is one of the kind of old rules that you need to follow by. I don't do that. I'm all in. I'm all in on gold and silver. I'm 100% in. Other than the value that's in our property and my home,
But that's not
everything's
all in. You're in 2 classes that are linked, but not the same. Okay.
right. But for me, I'm trying to have a maximum, or I guess I should say, I'm trying to have the best profile of minimal risk and highest reward. Okay.
Sure.
And there's a time and place where you get paid to own the best stuff, right? Like, and we're in that now. Like, we were at this time last year, we were at $28 silver.
I
It's
know. It's
75
incredible.
it's $75, right? So,
Mhm.
if you've been a client of mine for a year or more, you've tripled your account. There was a point earlier in the year where you were at 5 times, right, in January, but again, we're not buying it to get rich. We're buying it to basically have minimal risk and maximum return. In terms of all the various asset classes that you can look at across the board, there's not a better risk reward profile than in physical metals. Um, but with every single person, you got to figure out a couple things. You never want to have no access to cash. Okay, so that's something that I emphasize. You might have $100,000 saved, but that doesn't mean you can put $100,000 into gold and silver, because if something happens, your roof gets a leak, your car breaks down, you need access to cash. So I tell people, if you have a 6 month to a year of kind of emergency reserves, any
There's the Dave Ramsey advice, the
well,
emergency fund right there. Some
well,
things he
you
says
do.
are really good.
And you do, and I don't agree with Dave Ramsey on much, but that would be one of them. Is like, I don't want you to have to sell your gold and silver early. You can buy it today and sell it tomorrow. There's no problem with that, but I don't want you to have to cut yourself short from the upside that we actually have by being in a big precious metal cycle. The other thing is, it depends on where you're at in the retirement cycle. Like, if you're already in RMDs, if you're already on a fixed income, like if you're collecting Social Security, you need to figure out what you can invest that you don't need to touch for a couple of years, right? You can't really put anything into physical gold and silver if you can't leave it alone for a year or two, in my opinion, because then you set yourself up for success. Anyone who bought from me a year or two ago, they've doubled, tripled, and quadrupled their accounts. We will see another move of similar size over the next few years, but if you're buying with not a whole lot of breathing room, then it's not going to be great. Now, in terms of retirement accounts, we can move them over. IRAs, Roths, 401ks, 403bs, 457s, deferred comps. We can do it all. But again, you got to figure out, well, if you're leaving anything in the stock market or in the bond market or in mutual funds, which are most common in those types of funds, it's like, what are you exposed to, right? So you don't have to go all in on gold and silver, but what are you leaving on the table? Knowing that gold and silver will never go to zero, and very likely they'll never be really worth any less than they are right now. Do you want to leave 50% of your portfolio in your regular mutual fund account that will probably suffer a 30 to 50% loss at some point over the next couple of years? So again, for everyone, there's no cut and dry model, but it's interesting to note, I think it was in September, that the Morgan Stanley chief investment officer said that the new 60-40 should actually be 60-20-20. 60% stocks, 20% precious metals, or he said gold generally, and 20% bonds. Well, I can tell you right now, all the gold, all the silver, all the ETFs, all the mining companies, every single thing that's precious metals related amounts to about half of 1% in American portfolios. So to go from 0.5% to 20% is obviously, it's a 40 times move. I don't expect that we'll never have that kind of adoption, although I obviously think that people should be. My expectation is we'll see something like 3 to 5% total allocation before the cycle is done. That still basically implies we have to have 6 to 10 times more money flow into this space before it's done, which would also imply we could have 6 to 10 times type moves in the market cap or the price of gold and silver. And so again, I'm not buying it to make a lot of money. It just happens to be a bit of a symptom, right? Owning the best insurance pays when the climate is such that you need that. But again, you're not going to be given this advice to proactively seek out the best form of financial insurance. They're going to tell you, hey, stock market's fine, bond market's fine, and even if it goes down, it's going to come back. Well, we'll see about that. I think this high watermark theory that I have will probably prove to be correct, and that will spur another round of money printing, which I think is the bigger risk. Is what happens after we've all been through COVID. We saw what happened. Economic crisis occurs. $9 trillion was printed out of thin air in 2020. Rates were at almost zero. And what I think is happening now, this combination of high oil prices, a weakening economy, geopolitical conflicts, and most importantly, bond yields, making government debt more expensive to service, making personal and corporate debt more expensive to service. I think all that stuff is honestly the ingredients needed. I just can't tell you when or what the catalyst is for some kind of financial crisis. And I think it could be 2026 or 2027 when we have a, you know, 2008 slash COVID kind of hybrid crisis moment where everyone's freaking out, markets are going to go crazy, and the response from the government to essentially plug a hole in the sinking ship will be to print more money. And I think the next time it's not going to be 9 trillion. I think it's going to be 20 plus, and we'll go back to probably zero rates. And they won't want to do that. They just won't have any other choice but to do that to save the system. So as long as you're leaving the majority of your portfolio in dollar denominated assets, the nominal value might not change, right? You could be in cash and it's $100,000, but
But not buy your shit.
it only buys you $85,000. Like from last year to this year, 100,000 only buys you 85,000 worth of goods. And, fast forward 3, 4, 5 years from now, $100,000 might only buy you $25,000 worth of goods.
But
So,
but the interesting part is, Micah, what an ounce of gold bought you, the equivalent, what an ounce of gold was in dollars, what it bought you in 1926, it still buys you today.
yeah,
You can still buy it still has the same purchasing power, an ounce of gold in today's market than it had in 1926, which to me is incredible because what other asset class would do that?
I know. And I think obviously, currency devaluation is something that's a little bit more understood now. I think obviously seeing higher prices, seeing that your buck doesn't go as far, your paycheck doesn't put as much on the table every week or every other week. I think now inflation concerns are about as high as they've ever been. Although inflation's only slowly creeping up. It's like there's a big lag effect, right? The stuff that's happening now is really going to impact us in 6 months to a year. The fertilizer example is a good one, right? The chemicals and the urea and the stuff that needs to come through the strait that hasn't been, the stuff that's been growing, and you're a hobby farmer or a homesteader like me, the stuff that's in the ground right now was already fertilized a few months ago. And that crop is going to be fine. It's the stuff that has to go in the ground in the next 6 months that's going to cost 30 to 50% more. A year from now, we will have food inflation that probably is 30 to 50% more.
And
I heard,
that is, sorry to interrupt, but that is only those are only the recent signals. This is not taking into account the fires, the droughts, the regulatory issues, the other problems that we've been having in that sector for 10, 15 years
oh,
that have already caused so many
exactly.
domino effects. The meat plants and processing plants that have burned down over the last. I mean, there's
Oh,
at
yeah.
some point the domino falls, and
Well, and
you
not to mention, like the other thing I'm hearing a lot about is this tick, this tick stuff that's causing red meat allergies in people. Like, they've been actively sabotaging the agri-food sector, and cattlemen and ranchers and stuff like that for years, with all the red meat propaganda and all this other stuff. But it's just another long list of things that are happening to a sector that's going to make it a lot more unsustainable, and meaning higher prices and higher inflation. And that's the hardest thing to deal with is, the more expensive it is to feed your family, the worse it is. And the less you have to go around for all the other things you have to eat, you have to have a roof over your head. And obviously with rates and food prices and all this other stuff and getting places and energy in general, it's a really bad combo. So I don't know. I'm not saying any of this to doom and gloom. Like, I'm a pretty positive guy, actually. Like, I always hope for the best, but I prepare for the worst. That's why I can kind of have this, like, you know, happier disposition, because I can't do anything else to help myself. But I still think 99% of people aren't thinking about gold. And obviously that's in the allocation to precious metals being half of 1%. It's 99.5% of people don't think about it. So
yeah.
that's got to change. It's just that most people don't do things proactively, right? You only kind of do things once you've gotten, kind of the weather alert that the cat 5 is on top of your house or it's coming to your house. Well, you can't buy insurance at that time, right? You can't call your insurance
Exactly.
company and get a good policy. You have to have it well in advance so that when things do happen, you're already set.
Mike, I think one of the things that there's a barrier, there's a trust barrier. I mean, and I understand it. You work all your life. A lot of our viewers have worked for 40 years, have maybe accumulated some financial wealth, and now obviously you go, hey, I want to make a decision that's not going to eradicate that. That's going to work for me. That's going to be good. Who to trust? And the way that I've gotten to know you is you're not a salesperson. You're not a salesman, which I really appreciate. You're an advisor. And that's what our audience has told us. Like, man, talking to Micah on the phone, he just He asked me questions, he walked me through the whole thing, and I felt like I had the information that I needed to make the right choice for me. And this is sort of, that when you have that, then everybody feels good about moving forward. So I really appreciate that, and that's why we love working with you all.
Thanks, man.
So how, when if people want to get specifically in touch with you, can they, and how can they get in touch with you?
Yeah, so Noble Gold's website, noblegoldinvestments.com. You can call us up 877-646-5347. You can call and ask for me. I'm happy to work with everybody from your channel. Part of the reason why I do this is so that I can connect with more clients, obviously, but I have 10 other great colleagues. We're all qualified. We're all kind of the same. We're all kind of cut from the same cloth. We're all investors. We're not really salespeople. Um, People that want to maybe email me too. Like I've noticed I've done this on a couple of shows recently and it works better because some people are a little bit gun shy to pick up the phone.
Sure.
So you can email me. It's Micah, Micah at nobleira.com. And if that's an easier way to kind of get the ball rolling, then you can send me a note there and I'll have, thoughtful answers to your questions that way too. Um, but yeah, we're not a high pressure sales company. Like you call us up, I'll give you all the information. I don't even really, I mean, I will eventually get to it, but I don't ever really ask what you even want to invest. It's first, what's your situation? What are your questions? How does it work? How can I help you? Once we've done all of that, then we can talk about, what's your situation? What accounts do you have? And what do you want to move? And what are your thoughts? But I can't tell anybody what to do. They have to figure out these things for themselves. You can use my rules of thumb and my guidelines for what you can put in there comfortably. But again, I think like looking at all the various things on the investment landscape and the investment horizon, what has the highest reward, the least risk, certainly not bonds, certainly not stocks. I really am being genuine when I say that I think it's commodities in general, and I think it's gold and silver primarily.
And to be clear, people can purchase precious metals directly from you, have them shipped to their house, store them themselves. They can purchase precious metals from you. You have segregated storage spaces, where safes where it can be stored for them. If they want to invest in a gold-backed retirement account, they can do that with you guys. So you kind of do the 365 deal. You cover all the bases, right?
Yep, and a lot of clients do both. Like I'm set up, so I keep a lot of metal at home in this thing behind me here. Won't be disclosing my address anytime soon, but I keep
Good.
metal at home. We do cash purchases. It's securely delivered. It's fully insured. We've got it covered until it's in your hands. You sign for it to be released for our insurance. We move tens of millions this way every month, and it's super successful in terms of the program and how smoothly it works. But then I also have my wife and I's IRAs in our Dallas facility. I was there just in November. It's fully private, fully insured, maximum security. They do segregated only accounts. So it means that the metals you would own inside of your physical metals IRA sits in basically a safety deposit box. It's called a segregated account, but it's like a safety deposit box that holds just the contents of your IRA. You can go there, you can touch it. We send you audited photographs of your holdings the date that they're placed into your account. We're the only company that does that. You can call it home at any time. You can sell it at any time. And then you'd have someone like me working with you for the life of your account and for the duration of the ownership of your metals. So you'd have a dedicated broker or dedicated advisor, I should say. And yeah, so I do it. I've got it myself. Most clients do a little bit of both. I think you want to have some metals at your fingertips in case these things happen that we hope never do. Power goes down, grid goes down, dollar goes down, banks go down. And then I look at my IRA as kind of a longer term. We've got to get through all this stuff over the next few years. I'm looking to protect and grow my wealth the best way that I can. And I think that's obviously the way to do it. I'm putting my money where my mouth is. So appreciate all your thoughtful questions, John. And obviously I love being on your show. Is there anything else you want to cover before we wrap up here?
No, my friend, you covered it all. Thank you. I appreciate your attention to detail, your extensive knowledge, level headed, which it's kind of also a signature of Noble Gold. And I also wanted to say to everyone watching that we partner with Noble Gold because they're a family owned American company. We know the owner, we know the people that work there. They are like family, and it's not BlackRock, it's not Vanguard, not some big company, it's not some AI voice on the phone. Real people helping real people, and this is this is the kind of partnership that we want to be in. So thank you, Micah. We really appreciate you all at Noble Gold.
John, thank you so much, man. We'll see you again.
Yeah, I'll see you very soon. And Inspire Tribe, hop on over to noblegoldinvestments.com or call Micah directly or email him. We'll put all the info in the video description. We love you, we appreciate you, and we'll be back with you again very, very soon.